You are living inside a grand deception. It is an architecture of deceit so vast and so deeply embedded in our culture that you are likely unaware of its walls, its bars, and its guards. This prison is not made of steel or concrete, but of flickering lights, incessant noise, and a stream of digits that have been weaponized against your own mind. It is the world of the stock ticker, and it has been engineered with frightening precision for a single purpose: to prevent you from ever building true generational wealth. It achieves this by perpetuating a single foundational lie, a cognitive virus that infects the mind of almost every market participant. The lie is that a stock is a thing to be traded, that it is a volatile, blinking symbol on a screen, a lottery ticket with better branding, a digital token whose primary characteristic is its constantly changing price. This is the ticker symbol lie, and it is the most effective wealth destruction device ever conceived. It is a psychological trap designed to short-circuit the rational parts of your brain and plug directly into your most primitive, fear-based instincts. It turns ambitious, intelligent people into neurotic gamblers, compulsively checking their phones for the next dopamine hit of a green number or the cortisol spike of a red one. It forces you into a state of perpetual anxiety, making decisions based on microseconds of data, driven by the panicked headlines of financial news networks whose entire business model depends on your continued agitation. You have been trained to be a stock renter, a temporary holder of a digital abstraction, perpetually tossed about on the waves of market sentiment. You have not been taught to be an owner. An owner does not care about the daily mood swings of the crowd. An owner is not concerned with the chatter of so-called experts predicting the next week's market direction. An owner is concerned with a single profound reality: the underlying, long-term, cash-generating power of the business they possess. This is the cognitive chasm that separates the 99% of market participants from the one man who so thoroughly demolished this prison that he used its very bricks to build an empire of $90 billion. That man is Warren Buffett. His fortune is not a monument to his ability to predict stock prices, it is a monument to his systematic, lifelong rejection of the ticker symbol lie. He did not merely ignore the prison, he uninstalled its entire operating system from his own mind and replaced it with something radically different, something that is at the very core of his entire philosophy. He installed the Proprietor's operating system. This is not an investment strategy, it is not a tactic, it is a complete and total psychological rewiring. It is a mental model that forces the brain to view a $100 share of Coca-Cola with the same analytical rigor, the same emotional detachment, and the same multi-decade perspective as if he were purchasing the entire Coca-Cola company for $300 billion with every penny his family owned. There is no difference in the cognitive process. To Buffett, a stock certificate is not a piece of paper or a digital entry in a brokerage account, it is a legal deed. It is a document that grants him fractional ownership of real assets: the bottling plants, the delivery trucks, the secret formula, the global distribution network, the brand that is seared into the consciousness of billions of people. He is not renting a ticker, he is buying a piece of a business. This documentary is the deconstruction of that mental model. We will not be talking about price-to-earnings ratios or discounted cash flow models in the abstract. We will be reverse engineering the psychological architecture that makes those tools effective. We are going to expose the three foundational pillars of the Proprietor's operating system. First, we will explore the cognitive uncoupling, the brutal mental discipline Buffett uses to completely annihilate the concept of a stock's daily price from his evaluation of its intrinsic value. You will learn how he transforms market volatility from a source of terror into his single greatest tool for wealth acquisition. Second, we will deconstruct the Proprietor's due diligence, the intelligence-gathering protocol he uses to understand a business from the inside out, to build a qualitative mosaic of its competitive reality that is so profound it borders on insider knowledge. This is the process of moving beyond spreadsheets and becoming a true business analyst. And third, we will reveal the steward's mandate, the framework through which Buffett evaluates the management of a company not as hired hands, but as his trusted business partners, the stewards of his family's capital. By the end of this journey, you will understand that the greatest secret to Buffett's success is not what happens in his brokerage account, but what happens in his mind before he ever makes a decision. It is a shift from speculator to owner, from renter to proprietor, from gambler to steward. Prepare to be handed the keys to the prison. Prepare to uninstall the lie that has been holding you captive and install the mental framework for true, permanent wealth. This is the story of the proprietor's operating system. Let us begin with the first pillar, the most difficult and most important cognitive leap any aspiring investor must make. It is the act of psychological warfare against your own brain, a deliberate and sustained effort to sever the link between two concepts that the world relentlessly tries to fuse together, the price of a stock and the value of a business. This is the cognitive uncoupling. Imagine you own a highly profitable farm. It's a wonderful business. Every year, it produces a reliable and growing stream of income from the crops it yields. You know the soil quality, you understand the irrigation systems, you have a long-term contract with a major grocery chain. You understand its value. Now imagine that every single day, a man drives up to your farm. Let's call him Mr. Market. He is a peculiar fellow. Some days, he is euphoric, practically bouncing with excitement. On these days, he looks at your wonderful farm and offers to buy it from you for an absurdly high price, perhaps twice what you know it's truly worth. Other days he is utterly despondent, suicidal even. He is terrified of the future, convinced that a plague of locusts is imminent. On these days he looks at your same unchanged farm and offers to sell you his identical neighboring farm for a pittance, perhaps half of what you know it is worth. This man, Mr. Market, shows up every single day, without fail, screaming a new price at you. Now what is your relationship with this man? If you were a sane, rational farm owner, you would recognize him for what he is, a useful, if manic-depressive, business partner. His daily quotes are not a reflection of your farm's value, they are a reflection of his emotional state. You would ignore him on his euphoric days, perhaps even chuckling at his absurdity. But on his despondent days, when he offers you a bargain of a lifetime, you might just take him up on it and buy his farm, increasing your own wealth. His mood swings are not a threat to you, they are an opportunity. Your knowledge of your farm's intrinsic value acts as an unbreakable psychological shield against his madness. This, in essence, is the cognitive state Warren Buffett has achieved with publicly traded stocks. For him, the stock market, with its endlessly flickering ticker tape, is just a giant, institutionalized Mr. Market. The price it quotes every second is not a verdict on the value of Coca-Cola or American Express. It is merely the last price at which two people, often driven by fear or greed, agreed to make a trade. It is the manic chatter of the crowd, not the sober assessment of a business owner. The average person, however, does not see the market this way. They have been conditioned by the ticker symbol lie to believe that Mr. Market is an oracle. They believe his daily price quote is the truth. When the ticker flashes green, they feel smart, validated, and greedy. When it flashes red, they feel stupid, anxious, and fearful. They have fused the price of the stock with the value of the business, and in doing so, they have handed over their emotional state and their financial future to the whims of an irrational stranger. The cognitive uncoupling is the deliberate, forceful act of breaking this fusion. It is a mental discipline that requires constant reinforcement. It is the process of building a firewall in your brain that separates the signal, the long-term, cash-generating reality of the business, from the noise, the short-term, emotionally driven fluctuations of the stock market. How does one achieve this? Buffett employs several powerful mental tools. The first is a simple but profound reframing question he asks himself before any purchase. Would I be willing to buy the entire business for this price? If he is considering buying $1 million stake in a company with a total market capitalization of $1 billion, he forces himself to ignore the $1 million figure. Instead, he asks, if I had $1 billion, would I use it to buy this entire company, all of its factories, all of its employees, all of its problems, and hold it for the next 30 years? This question performs a powerful psychological sleight of hand. It instantly vaporizes the ticker symbol. It removes the abstraction of the stock and replaces it with the tangible reality of a whole business. You are no longer gambling on a number going up. You are making a capital allocation decision to acquire a productive asset. This simple question forces you to engage with the business on the terms of a proprietor, not a speculator. It compels you to think about durable competitive advantages, the quality of management, long-term industry trends, and return on capital. It forces you to think about value. The second tool is an inversion of emotional response. For the person trapped by the ticker symbol lie, a falling stock price is a source of pain and fear. It is a signal that they made a mistake. Their primitive loss aversion instinct kicks in, screaming at them to sell, to make the pain stop, to cut their losses before they get worse. This is the biological programming that guarantees the cycle of buying high and selling low. Buffett, having successfully performed the cognitive uncoupling, experiences the exact opposite emotional reaction. Because he has separated price from value, a falling price for a wonderful business he already owns or wants to own is not a threat, it is a gift. It is Mr. Market showing up on his suicidal day, offering a bargain. If he has already determined that the intrinsic value of his farm is, say, $1 million, and Mr. Market suddenly offers to sell him another one for $500,000, his emotional response is not fear, it is excitement. He gets to buy more of a wonderful asset at a cheaper price. He famously articulated this after buying a large stake in a company, only to see its stock price fall by nearly 50% in the following months. A reporter asked if this made him nervous. He responded, "No, it's like buying a hamburger. If I go to a restaurant and order a hamburger for $2, and the next day I go back and the same hamburger is on sale for $1, I don't feel worse. I feel better. I get to buy more of what I like for less money." This is not just a clever analogy, it is a window into a fundamentally different mental operating system. For him, a falling stock price of a company whose underlying business value is unchanged or improving is a sale. It is a Black Friday event for asset acquisition. This emotional inversion is only possible through the rigorous initial work of the cognitive uncoupling. Without a deep, bedrock conviction in your own assessment of a business's intrinsic value, you have nothing to anchor your mind to when the storms of market volatility arrive. You will be tossed about by the waves of fear and greed, because the only reality you know is the flickering price on the screen. The history of Buffett's career is a series of masterclasses in exploiting the gap between price and value created by market panic. During the 1973-74 market crash, when stocks were decimated and major publications were declaring, quote, "the death of equities," Buffett was quietly and methodically buying up massive stakes in companies like the Washington Post Company. He saw the panic for what it was: Mr. Market in a deep, clinical depression. While the world was fixated on the terrifying price action, Buffett was calmly assessing the enduring value of the Post's media franchise, its competitive moat, and its cash-generating power. The price was what you paid. The value was what you got. He was getting $1 of value for 40 cents, and he knew it. Fast forward to the financial crisis of 2008. The entire global financial system seemed to be on the brink of collapse. Fear was palpable. The ticker tape was a waterfall of red. For most, it was a time of pure terror. For Buffett, it was an opportunity of a lifetime. His phone started ringing. He wasn't panicking, he was deploying capital. He invested billions in Goldman Sachs and General Electric, not because he could predict the bottom of the market, but because he was a proprietor buying stakes in what he believed were fundamentally sound, critical businesses at prices dictated by extreme fear. He was not a stock trader timing the market. He was a capital allocator providing liquidity to a panicked system in exchange for an ownership stake on incredibly favorable terms. He was able to do this because his mind was not tethered to the price. It was anchored to his assessment of long-term business value. The cognitive uncoupling is not a one-time event. It is a continuous mental practice. It requires a deliberate choice to starve your brain of the very inputs that the financial world wants to gorge it on. It means turning off the financial news. It means not checking your portfolio obsessively. It means cultivating an environment of informational quiet, so that the faint signal of business reality can be heard above the deafening roar of market noise. It is the first and most crucial pillar of the proprietor's operating system, because without it, all other analysis is useless. You can do the most brilliant analysis of a company's competitive advantages and financial statements, but if your mind is still chained to the daily fluctuations of its stock price, your emotions will inevitably override your intellect. You will be a brilliant analyst and a terrible investor. You will become the man who knows the price of everything and the value of nothing. The first step to escaping the prison is to stop rattling the bars. It is to recognize that the flickering numbers on the screen are not your reality. They are a tool to be used, not a master to be obeyed. They are the ravings of Mr. Market, and they are only powerful if you let them be. Annihilate the price from your mind, and you have taken the first giant leap toward thinking like an owner. Once you have successfully built the psychological firewall between price and value, the next phase of the proprietor's work begins. You have insulated yourself from the noise of the market. Now you must immerse yourself in the reality of the business. This brings us to the second pillar of the proprietor's operating system, the proprietor's due diligence. This is not the passive, spreadsheet-driven analysis taught in business schools and practiced by most of Wall Street. This is an active, investigative, and deeply qualitative process of understanding a company from the ground up, as if you were about to purchase it in its entirety with your family's entire net worth. It is a mental model borrowed and refined from one of the other giants of investment philosophy, Philip Fisher, who called it the scuttlebutt method. Scuttlebutt is an old naval term for the cask of drinking water on a ship, around which sailors would gather and exchange gossip. Fisher's genius was to apply this concept to investing. He argued that the most valuable information about a company couldn't be found in its annual reports or official press releases. Those documents are sanitized, polished, and legally vetted. The real, unvarnished truth, Fisher believed, could only be found by talking to the network of people who interact with the company every single day. Its customers, its suppliers, its competitors, its former employees, its trade association executives. Buffett internalized this methodology completely. He understood that to be a true owner, you had to understand the business, not as a collection of financial statistics, but as a living organism operating within a complex ecosystem. The proprietor's due diligence is about building a rich, multidimensional, qualitative mosaic of that reality. It is the difference between reading a tourist brochure about a city and actually living there for a year. The tourist knows the famous landmarks. The resident knows which streets to avoid after dark, where to get the best coffee, and the hidden dynamics of the local politics. Buffett seeks to become a resident of every business he owns. Consider the fundamental difference in the questions a proprietor asks versus the questions a speculator asks. A speculator, trapped by the ticker symbol LI, asks, "What will the stock do next quarter? Did the company beat earnings estimates by a penny? What is the market sentiment around this stock? Is there a new technical chart pattern forming?" These are questions about price and perception. A proprietor asks a completely different set of questions. Why do customers choose this company's product over its competitors? And will that reason still be valid in 10 years? If I were a competitor, how would I try to attack this business? And what are its weakest points? How much pricing power does this company have? Can it raise prices without losing significant business? What is the relationship like with its key suppliers? Are they partners in a value chain? Or is it an adversarial relationship? What is the morale of the employee base? Are they proud to work there? Or is it a toxic environment with high turnover? What are the real, unstated risks to this business that aren't listed in the risk factors section of the annual report? These are questions about the fundamental, long-term reality of the business. They cannot be answered by a financial model. They require investigative work. They require scuttlebutt. Buffett's application of this method is legendary. Before he made his famous investment in American Express in the 1960s, the company was on the brink of collapse due to the salad oil scandal. A major client had defaulted on massive loans secured by fictitious inventory of salad oil. Wall Street panicked, assuming American Express would be liable for hundreds of millions in losses, potentially bankrupting the company. The stock price was annihilated. Buffett, however, didn't look at the ticker. He started his scuttlebutt. He went to restaurants and travel agencies. He talked to merchants. He observed customers. He was trying to answer a single vital proprietor's question. Has this scandal damaged the core value of the American Express brand and its Traveler's Check franchise? He discovered that customers were still using the Traveler's Checks, and merchants were still happily accepting them. The scandal was a financial problem, a big one, but it had not broken the fundamental trust that formed the company's economic moat. He concluded that the underlying business was worth far more than the market was pricing it. He made a massive bet, 40% of his partnership's capital, and made a fortune. That was not a stock trade. It was a piece of proprietary business analysis conducted in the public markets. Think about his investment in Coca-Cola. He didn't just look at their sales growth and profit margins. He had been observing the business his entire life. He saw the brand's power firsthand. He once tasked his Omaha office staff to conduct a survey of how much Coca-Cola a person in a foreign country consumed versus how much they would consume if it were as readily available and affordable as it was in the United States. He was calculating the size of the untapped market, the potential for growth. He spoke to a friend who had owned a Coca-Cola bottling plant for decades, gaining a ground-level understanding of the economics and competitive dynamics of the distribution system. He was building his mosaic, piece by piece, until he had a level of conviction that was unshakable. This process of deep investigation serves a dual purpose. First, it provides the raw material for a more accurate assessment of intrinsic value. It allows you to see the hidden strengths and weaknesses that the market, with its short-term focus, often misses. Second, and perhaps more importantly, it is the very process that forges the psychological conviction necessary to withstand market volatility. It is the antidote to the fear that Mr. Market peddles. When the price of Coca-Cola dropped after he bought it, Buffett didn't panic. Why? Because his confidence was not based on the stock's price performance. It was based on his deep, proprietary knowledge of the business's unassailable brand, its global distribution power, and the simple, enduring human desire for a cold, sweet drink. His conviction was rooted in business reality, not market perception. In today's world, the tools for scuttlebutt are more abundant than ever. The internet provides access to a universe of information, if you know how to filter it. You can read customer reviews on countless websites. You can watch video interviews with former executives. You can browse online forums where employees discuss their company culture. You can use services that track shipping data to get a sense of a company's real-time sales volumes. The modern proprietor can become a world-class investigative journalist from their own desk. The key is to adopt the mindset. It is to approach a potential investment not as a stock to be bought, but as a business to be understood. It requires a fundamental shift from passive data consumption to active intelligence gathering. It demands immense curiosity and a willingness to go beyond the obvious. This pillar is hard work. It takes time. It is the reason why Buffett's other famous mental model, the circle of competence, is so crucial. You cannot possibly conduct this level of deep-dive due diligence on hundreds of companies or dozens of industries. It is simply not feasible. That is why he insists on staying within a narrowly defined circle of businesses that he can genuinely understand. A proprietor doesn't buy a little bit of everything. A proprietor buys a few things they understand completely. The ticker symbol LI encourages a form of intellectual laziness. It seduces you into believing that all you need to know is the name of the company and the direction its chart is pointing. The proprietor's due diligence is the cure for this laziness. It is a call to intellectual rigor, to deep thinking, and to the hard, satisfying work of truly understanding what you own. When you have done this work, when you have built your mosaic and know the business as well as, or even better than, its own management, the daily stock quote becomes what it truly is, an irrelevant distraction. You have replaced the noise of the market with the knowledge of the proprietor. You are no longer guessing, you are owning. You have performed the cognitive uncoupling, severing your emotional state from the market's manic depressive swings. You have executed the proprietor's due diligence, building a deep and resilient understanding of the business's underlying reality. Now, you must confront the final, crucial element of ownership. A business is not just a collection of assets and a competitive position. It is a group of people. As a proprietor, you are not just buying a company, you are entrusting your capital to the individuals who run it day to day. Your success or failure is inextricably linked to their decisions, their character, and their competence. This brings us to the third and final pillar of the proprietor's operating system, the steward's mandate. This is the framework for evaluating management, not as corporate executives, but as your personal business partners, the trusted stewards of your wealth. For Buffett, this is not a minor consideration, it is a deal breaker. He has stated that he would rather invest in a great business with good management than a good business with great management, but he will never, ever invest in any business, no matter how wonderful, if he does not trust and admire the people at the helm. This is because a poor manager can destroy even the most formidable economic moat through foolish acquisitions, irrational capital allocation, or a simple lack of integrity. A proprietor must choose their partners wisely. So what does Buffett look for in these partners? He famously boils it down to three essential characteristics: integrity, intelligence, and energy. He is quick to add that if they don't have the first, the other two will kill you. Integrity is the non-negotiable foundation. Does management have a history of being candid and transparent with shareholders, especially when things are going badly? Do they treat the company's money as if it were their own? Or do they treat the corporate jet like a personal taxi and the company's treasury as a piggy bank for lavish perks and ego-driven acquisitions? Buffett dissects the language of annual reports, looking for signs of candor versus signs of obfuscation. He reads the chairman's letter first, and if it is full of jargon, self-congratulatory fluff, and a refusal to acknowledge mistakes, he is immediately skeptical. He loves managers who write simply and clearly, who admit their errors, and who explain the business's economics in a way that an intelligent layman can understand. This is the behavior of a partner, not a salesman. He looks for managers who are obsessed with the business itself, not with the stock price. A manager who is constantly talking about hitting the quarterly numbers or managing shareholder expectations is a red flag. This is the language of a speculator, someone who is playing the market's game. Buffett wants a manager who is obsessed with widening the company's economic moat, delighting its customers, and increasing its long-term per-share intrinsic value. This is the language of a proprietor. Intelligence, in Buffett's view, is not about having a high IQ or a fancy MBA. It is about a specific kind of business intelligence, the ability to allocate capital rationally. This is the single most important job of a CEO. A company generates cash from its operations. The CEO then has 5 choices for what to do with that cash: reinvest it in the existing business, acquire other businesses, pay down debt, issue dividends, or repurchase shares. A manager who is a brilliant operator but a terrible capital allocator can destroy immense value over time. Buffett looks for a track record of rational, shareholder-friendly capital allocation. Does the manager reinvest capital in projects that are likely to earn high rates of return? Or do they engage in diversification, buying unrelated businesses they don't understand, simply to make the empire bigger? Do they repurchase shares when the stock is trading below its intrinsic value, thereby increasing the ownership stake of the remaining shareholders? Or do they issue shares at depressed prices, diluting the ownership of the existing proprietors? These are the questions a true owner asks. They are looking at the CEO as their chief capital allocator, the person responsible for reinvesting their share of the profits. Buffett's longtime partnership with Tom Murphy, the CEO of Capital Cities/ABC, is a textbook example of what he looks for. Murphy was a brilliant operator, but he was a genius at capital allocation. He ran his businesses with extreme decentralization and frugality, and he was ruthless about only reinvesting capital in opportunities that promised high returns. He treated his shareholders' money with more care than he treated his own. He was the perfect steward, the perfect partner for a proprietor like Buffett. The third quality, energy, is straightforward. Buffett wants leaders who have a passion for the business, who are driven, and who love what they do. He is not interested in caretaker managers who are simply counting the days until their retirement. He wants builders, people who are energized by the challenge of making the business better every single day. This steward's mandate is embodied in a powerful concept that Buffett frequently uses: look through earnings. When you own a stock, you are legally entitled to your pro rata share of the company's earnings, regardless of whether the company pays them out as a dividend. If a company earns $10 per share and pays out a $2 dividend, a speculator might only think about the $2 they receive. A proprietor, however, understands that they also own the other $8 that the company retained. Their net worth increased by the full $10. The critical question then becomes, what is the CEO, my partner, doing with my $8? Are they reinvesting it at a high rate of return, compounding my wealth internally? Or are they squandering it on a foolish acquisition? The concept of look-through earnings forces you to think like a silent partner in the business. The retained earnings are your money, being managed on your behalf by the CEO. This perspective makes the evaluation of management's capital allocation skills paramount. It is the heart of the steward's mandate. Contrast this with the typical Wall Street approach, which often celebrates celebrity CEOs who are masters of promotion and stock price manipulation but may be terrible long-term business builders. The proprietor is immune to this charisma. They are not looking for a rock star. They are looking for a reliable, trustworthy partner who will compound their capital safely and effectively over many decades. By applying this three-pillar framework, integrity, intelligence, energy, and by adopting the look-through earnings perspective, the proprietor completes their mental model. They have psychologically insulated themselves from market volatility. They have done the deep investigative work to understand the business's reality. And they have rigorously assessed the character and competence of the people to whom they are entrusting their capital. At this point, the investment decision is almost an afterthought. The conviction is total. It is not a speculative bet. It is a reasoned, long-term business decision. This is the full expression of the proprietor's operating system. It is a system that transforms investing from a game of chance into a discipline of ownership. It is a system that is designed not for quick wins, but for the slow, relentless, and inevitable compounding of generational wealth. It requires patience, discipline, and a profound shift in mindset, but it is the only system that truly escapes the prison of the ticker symbol lie and allows you to participate in the magnificent, long-term value creation engine of great businesses. You have been given the blueprint. We have deconstructed the three pillars of Warren Buffett's most foundational mental model. First, the cognitive uncoupling, the psychological discipline to sever the link between a business's value and its daily stock price, transforming market volatility from a threat into an opportunity. Second, the proprietor's due diligence, the investigative protocol for building a deep, qualitative understanding of a business from the inside out, forging a conviction rooted in reality, not perception. And third, the steward's mandate, the framework for evaluating management as your trusted business partners, the stewards of your capital. Together, these three pillars form a complete cognitive program, the proprietor's operating system. Installing this system is not an intellectual exercise, it is an identity shift. It is the conscious decision to stop being a gambler, a speculator, a renter of tickers. It is the commitment to become a true owner, a long-term partner in the value creation of wonderful businesses. This is the mental architecture that allowed Warren Buffett to ignore the noise, to sidestep the panics, and to patiently compound his capital into one of the greatest fortunes in human history. It is a system built on rationality, patience, and a profound understanding of what an investment truly is. But there is a hidden prerequisite. There is a fundamental piece of your own mental software that can make the installation of this entire operating system impossible. This proprietor's mindset, at its very core, is about thinking and acting for the long term. It requires a perspective that stretches out over years, and ideally, decades. But what if your brain is not wired for that? What if the modern world has programmed you with a defective clock? It has. It's a hidden mental timer that forces you to think in days, weeks, and quarters, creating a constant, low-grade anxiety that poisons your decisions. This short-term sickness is the invisible prison that guarantees mediocrity for even the most ambitious people, and it is the single greatest enemy of the proprietor's mindset. Warren Buffett's $90 billion fortune was not built with this defective clock. It was built by systematically uninstalling this cognitive virus and installing a radically different operating system, the perpetual time horizon. This isn't just about long-term investing. It is a complete rewiring of the human brain to perceive and weaponize time itself, turning the market's manic impatience into your single greatest asset. To complete this mental upgrade, to truly make the proprietor's operating system function as intended, you must first deconstruct and rebuild your own perception of time. You must uninstall the clock that makes you poor. To begin that critical process, click on the video now appearing on your screen. It is the next non-negotiable step in your journey to acquire the mind of a master investor.